Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner.
Hello, everybody. Welcome back to Real Estate Milestones. Today we have Stuart Keller with Lloyd Jones Capital, a Miami-based private equity firm who specializes in multifamily and senior living. And today we're going to talk a lot about senior living asset class. I find it very exciting, but we both know, and I think we all know, it's not the sexiest, but I think when you hear about the returns and about the advantages from a real estate and risk-adjusted return perspective, you'll see what we mean. But Stuart, welcome on the show.
Ben, absolutely stoked to be here. Looking forward to catching up and really diving into kind of what the future of senior living holds for the United States and our investments.
Yeah, I'm excited as well. But before we get into it, I'd love to hear about your first milestone in real estate.
So my background, I was after grad school, got a master's degree in international economics, and first foray into real estate private equity was as green as possible, working for a boutique shop out of Orlando, basically buying REO bank-owned assets and non-performing loans, following the 2008 crash in 2010. Did that for about 3 years, moved into operations in multifamily, overseeing properties as a regional manager. Given my background and kind of heavier finance, moved into a regional vice president role, did that for about 7 years. And then back in 2018, joined Lloyd Jones originally to oversee the management side of the shop. And then 5 months in, I guess just kind of my financial experience and the reports I was doing and delivering, I was actually appointed to be head of asset management, where I really took our asset management division to next level. Getting back to your question, my first major milestone was probably when I was in asset management here at Lloyd Jones, and it was the first loan that I'd ever done a refinance on, and it was a sticky deal. It was a CMBS note. It was very much kind of feeling my way along, really understanding how the different refinances worked, what it looked like. It was a small loan. It was like $3 million or something. But, that was probably my first time of doing something completely independently, and really running point on all facets of a project.
Awesome. So what did you learn from that?
The level of detail that goes into, it doesn't matter the size of the loan, whether it's $100 million loan or whether it's $1 million loan. When it's collateralized by commercial real estate, there is a significant amount of hoops to jump through. And it was, just being able to deliver, execute, and make sure that all of the different parties, from our counsel to lenders counsel to your investment partner, their investment partners counsel. Does your investment partner also have a limited partner? Being able to ensure that everybody's on the same page and you're also falling in accordance with, the various operating agreements from both a partnership level and an LP level.
Yeah, well, I guess that's why they call it a relationship business.
Yeah,
Every deal has
absolutely.
tons of parties.
Yeah, absolutely.
Yeah. Well, awesome. I'm glad that's pretty interesting and sounds like a cool experience. Well, let's get into it. So let's start. What's the silver tsunami that we're all hearing about?
Yeah, so the silver tsunami. So back in 2018, 10,000 baby boomers started turning 65 every single day. Now, fast forward to 2022, that same leading edge of baby boomers started turning 75. So what you're actually seeing within the United States right now is this rather significant demographic shift, both in terms of the number of seniors, but the ratio of those 65 and older and those 18 to 64. So what you're seeing right now is the number of baby boomers are going to, it's going to quickly accelerate. And as such, senior living is very much a need-based housing or, living community versus a want-based. So when you get into the different levels of senior living, you've got your age restricted, which is, very much very similar to multifamily, but with the age component. And then you move into the independent living, assisted living, and memory care. And as you elevate within each level of care, so does your operating expenses, so does your rent, and so does the technical component of being able to care for the residents. And to really make things even spicier, when you look at just the total available housing, and this is before supply chain, this is before COVID, the senior living, and this is just raw data that I've pulled from Statista online, is when you look at, they've been delivering anywhere from 35,000 to 50,000 units a year. The peak was in 2018 to 2019. They had delivered 65,000 units. So based on the number of seniors turning 75, by 2030, if 1 in 5, so 20%, choose to live in a senior or need to live in a senior living community, just 20% of those folks, there's going to be anywhere from a 1 million to 1.5 million unit shortfall. On the flip side, you're like, oh, well, they're still building. Well, in 2021, we're actually at the slowest rate of new construction deliveries over the past 10 years. If not the past 15 years. I do have to kind of look at the statistics again. But then, okay, yes, so there are units being delivered, but the units that are being delivered by new builders are targeting the top 10 or 20% of those senior citizens. So they're much more expensive. And they're also in the top 5 major markets within the Sun Belt. So yes, the units are being delivered, but they're being delivered in the wrong areas because 80% of seniors choose to return home to where they grew up, to where a majority of their family lives, when they enter or choose to live in a senior living facility. So you're seeing this really dynamic shift between, you've got this, demand that's coming. It's not an if, it's not a maybe, it's coming. It's going to be a full-blown crisis by 2030. And what we're doing here at Lloyd Jones is like really taking a philanthropic, approach to private equity, saying, okay, we're going to target the middle market. Senior living, kind of what we spoke about before the call is, it's not sexy. It's had this kind of stigma around it. It's like, oh, it's a nursing home. Like even my wife the other day was like, oh, isn't it just a nursing home? I'm like, no. Like you walk into these communities and it's like you walk into a hotel. It's a community. There's music playing. There's smells. There's activities. There's dining rooms. You walk into these communities and it is a full living experience for these residents. And the need and our approach and delivery is to really target the 60% by enhancing the living experience, but not charging the Ritz-Carlton prices. We want to have a Ritz-Carlton experience, but at a bed and breakfast, rate.
Right. So, wow, we got a lot to unpack now. So, yeah, I would love to stick on the theme of the missing middle. I know I've heard this idea before that, most of the people who are developing these projects trying to target the top end because that's where you get the highest rents.
Yeah.
And there's the entire business is very operationally expensive, right? The OpEx ratio or the percentage of your income that goes to costs are higher than most asset classes. So I want to know, how are you able to reach the missing middle without, getting too squeezed? What strategies do you have to make it profitable for you and also still deliver the quality that that we'd love to make sure everyone has?
Yeah. So, great question. Our approach and what we're seeing a lot right now in the market is you've got these major institutions that just got absolutely hosed during the pandemic. It was incredibly saddening to see the disproportionate impact on senior citizens due to COVID-19. Um, you know, these residents either moved home or unfortunately they passed away due to complications from COVID. The policies in place, you know, whether it's at the community level, the state level, or the federal level, prevented new residents from coming in and moving into these communities. So you saw the sharp decline in occupancy, a sharp decline, revenue is price times quantity. So when your quantity goes down, but your price is static, your total revenue is going to go down, your cash flow is going to go down. So these properties were offsetting and causing, net losses, whether they were owned by a REIT or whether they were in a portfolio or a fund. So what we're doing right now is we're working with these different institutions, these REITs and brokers, finding opportunities, buying them right, and then being able to invest CapEx dollars and still provide favorable returns. Now, couple great examples. We have a deal in Valparaiso, Indiana. Very few people have heard of Valparaiso. Population's like 50,000. It's actually home to one of the best universities in the Midwest. But we bought it for $9.5 million. Who we bought it from, they paid $16.5 million. And the prior owners before that bought it for almost $19 million. So our basis at, little over 200,000 per unit is well below replacement cost. So you've got this kind of built-in equity right up front. And the key strategy is to, enhance the community, give it a refresh while still maintaining what the seniors desire. And then, just moving the residents in through effective advertising, effective customer service, and being able to maintain higher revenue to offset, the operating expenses.
So yeah, that makes sense. Something I'm curious about is, given that we know demand is going to go up and supply is lagging demand, right? That usually, if you go back to Econ 101, that usually means prices go up. I wonder how much risk is there that even though demand's there, supply and prices going up, what's the risk that people just simply can't afford it, no matter how much they need it? Would that force them into just moving in with their kids? Would that find some other solution, like just normal housing? What are the other options for people? And I guess just to build in a little bit more to that, do you think about how fixed, or some people are paying with fixed income, retirement plans, how your prices need to correlate with that? Is that something you think about? Or is it more this kids or other people helping them pay for housing?
Yeah, so I'll address that kind of last question first. So when we're underwriting deals, you're looking at not only of the income qualification of the resident, whether they're going to pay for that out of their savings, or if they're going to pay for that out of the equity in their home. So typically what you see is this affordability index when you underwrite a property. Typically to be income qualified, it's anywhere from $30,000 to $50,000 a year. The average length of stay for a senior living community is between 2 and 2.5 years. Now, you're also going to be looking at the income demographics of the family members, of the sons and the daughters of these residents. So that's also going to, take into account a big play. Now, understanding the affordability is crucial in where you set your rents. On the flip side of that, you mentioned something about, seniors living at home. That's okay to a point, but the level and the kind of technical aspect of the skill level of care if you have a parent or a loved one that has dementia, whether it's early onset, one of the characteristics of someone with, cognitive impairment is that they wander. You don't want them going out of the house. So there's definitely I don't want to call it security issue, but you have a kind of containment issue that living at home is safe. Precisely. Now, fast forward even more is the ratio of those 18 to 64 in the 50s was almost 5-1, meaning there were for every, 5 people ages 18 to 64, so working, relative to those 65 and over was 5-1. What the silver tsunami is doing is we're actually going to see that ratio approach a 1-to-1, where 0 to 18-year-olds is going to become the lowest percentage of the population that we've ever seen. So there's going to be a disproportionate share of those needing senior care relative to those that can deliver it. So from that standpoint, I mean, there's going to be very much a need-based demand. Now, if it's a independent living, like my father-in-law, for example, he's 86, guy's still hanging hurricane shutters, at his house, at his house in Southeast Florida, drives my wife nuts. If it gets to a point that he just needs a little help, or maybe he doesn't want to live at home by himself anymore, yes, then that would be a great opportunity for him to move in. But if there's like cognitive issues, cognitive impairment, I don't want him getting up at 2 a.m. and turning on the gas stove. Like, that just not going to happen. If he needs help getting his medicine delivered to him or, measured, that's not something that I'm qualified to do.
Yeah, that makes a lot of sense. First thing, given the population, disparity in the ages, don't forget to have kids, guys. We need that. We need to replace the population. We need people who are productively contributing to society to support all this.
That'll be a 18 to 25 year lag. Even if we just started getting after it right now. I mean, there's childhood, and then getting a job, and then being able to 6-figure income. It's going to take a bit. So a lot longer than the next 5 to 7 years when the full effect of the silver tsunami is here.
Well, it sounds like there might be an opportunity, because I heard there was a shortage of labor in the I guess skilled labor, nursing labor in the senior living, assisted living, the entire industry. I know that the fact that you need skilled labor is also a reason why the operational expense is higher, because you're not just having a normal property manager that does accounting. We're having nurses who are giving people their meds every day. Like, it's not the easiest job. I've been in facilities before, and I've seen it, and it's definitely seems a little thankless. But I wonder how you're approaching that problem, because I know if you can't have the labor, there's nothing you can really do to support the residents. So I'd love to hear your approach to that. What you think about from a macro economy level, like where, like, are we gonna find these people? And yeah, how are you addressing it?
Yeah. So, great question. So what we're doing, at Lloyd Jones, and Lloyd Jones, Miami based, is, we have a subsidiary called Aviva Senior Living, which is our operations arm. Now, Aviva Senior Living is broken out into 4 regions. We have the Northeast, the Southeast, the Midwest, and the Southwest. Each of these 4 regions is going to have its own CIO and COO. The CIO is going to be, running point on the underwriting, the acquisitions, and the asset management, whereas the COO is going to be, largely living within close, reach to these different properties for operational oversight. And then supporting these 4 regions is going to be 2 to 3, what we're calling transition teams. Now, these transition teams, they're all over the United States, but when there's a staffing shortage, or, an executive director that, maybe there's a job opening for whatever reason, they will be able to go in and fill those roles. So it is a corporate role paid for by the management fee that we will actually, send somebody out there, whether it's a director of nursing, director of, services, director of, activities, or even the executive director of the property, will have somebody go in there and be able to fill that need. So yes, there is definitely a staffing shortage. And then kind of one of the other metrics is, yes, these properties are more expensive to operate, but the rents are also materially more than a multifamily deal. Just kind of taking a step back, when you look at a multifamily deal, and this is just all complete arbitrary numbers, right? So you have a 1-bedroom apartment in multifamily, $1,000 a month. Just the sheer transition of going from a multifamily deal to an age restricted deal. An age restricted deal, your average resident, stay is going to be 7 years, and the rents are going to be anywhere from 15 to 20% higher than a multifamily deal. So your rents automatically go from 1,000 to, call it 1,200. Your operating expenses are going to go down because of less unit turns. And then as soon as you go into independent living, you're going to have really the only difference between age restricted and, independent living is, food and the 3 meals a day. And typically in an IL property will have a full service commercial kitchen. So, you're providing meals. You're also providing, typically they'll have a barber, they'll have a library, they'll have a salon, the level of amenities, because this is everything that they're going to need to live comfortably is going to be within the property, as well as like a bus to take them out shopping and take them to different activities around town. So senior living deals are really underwritten on operating margin ratios as opposed to a strict OPEX over total revenue, because as you get the variances in care with any sort of community, you might have, 10% of the property be memory care and 90% of the property be independent living or assisted living. You're going to have to balance out from an underwriting standpoint what that true operating margin is, because when you mash it all up into one income statement and then you start doing that kind of high level analysis, it'll definitely be skewed because of the ratios within that actual community.
Mm-hmm. Yeah, that makes sense. I guess to bring this into the market, inflation hits the cost and hits the top line.
Yep.
One of the great things about real estate is that when there's inflation, you know, rents are part of the thing that gets inflated, so you're kind of hedged against inflation. But
Yeah.
the thing is, when your costs are high in senior living, that might even be squeezing your margin if it's in lockstep, which hopefully it's not. But I want to know if that's something you underwrite, and if that is something that can be mitigated, and like, is there a risk there?
Yeah, so definitely, it's something that we pay attention to. Typically in our underwriting, unless it's a true opportunistic buy with a lot of meat on the bone, we're pretty conservative in our rental growth rates. In multifamily, when I was, helping on acquisitions, we would underwrite to 12% rent growth year one, then throttle back to like 8%, then maybe 7%, especially when we were just seeing these crazy, insane rental prices, right? Senior living, we're typically underwriting to 3 to 4% rent growth, understanding that the rising costs and those rising margins are going to negatively impact the return profile. However, when we actually are operating the property, we're going to kind of be in line with the market. So although we underwrote a 3%, it might be closer to like a 7%. Being able to follow, fair housing guidelines and apply to all the residents equally. So from that standpoint, we're really looking to under promise and over deliver as far as the return profile is considered. But yeah, I mean, everybody, whether it's the, Starbucks here in Ponte Vedra or it's, a senior living community in Lincoln, Nebraska, this the rate of inflation and cost of living is just absolutely crushing everybody, regardless of the industry.
Yeah, that makes sense. So back to the fact that there's like a shortage of new supply. I know that given that it's not just a normal multifamily, there's a lot more. I guess there's more permitting and there's more difficulty given government regulation. And I kind of want you to just paint a picture of why it might be more difficult to develop senior living, and how you might address that. And is it, yeah, is there certain reasons why it's more difficult to build?
Yes. So, other than, the supply chain issues brought on by COVID, the macroeconomics going on around the world between Ukraine, Russia, I mean, even China is concerned. You know, what we're doing, as far as being able to meet the demand. So each state has its own licensing requirements. So these senior living deals are structured in a way that has an operating company and a property company. Property company actually has the building, the asset, everything, and then the operating company will have its own set of licenses. So there's definitely a technical and legal back end that's much more complex. But what we've actually done and are doing is hotel conversions. So you've got these extended stay hotels that are anywhere from, mid-rise to, 7 stories to 12 stories. They have their own little kitchenettes already in there. Is we're actually going through and we're converting these. So we're working with the state, the county, being able to revamp these extended stay hotels into independent living or even assisted living communities, because they've already got all of the, they have the commercial kitchen, they have the large dining areas, they have everything you need to be able to make it a really well-built senior living community, as opposed to going out and building. Right now we have a couple of deals under construction, which, like any other builder right now, is facing supply chain issues. So that's definitely hampering our ability to, really anybody's ability to quickly and efficiently deliver new product. That's also in line with the middle market price point.
That's exceptional. That you hotel conversions, I not thought of that. So that, I mean, that makes sense. Like, it is a hospitality product in a way. It's a community rather than a just a roof. you
Yeah.
know. So, but yeah, that's
Yeah.
really exciting actually, and I'm gonna have to ruminate on that. So, um, you know, lastly, before we get to the lightning round, I'm just curious to hear what you think, because I think the most unsettling or the most interesting, weird part about senior living is that a vacancy doesn't means that someone might have passed on to somewhere else besides their next living residence.
Yeah.
So I wonder how you address that in terms of a turnover and like I guess
Yeah.
reoccupancy, and then also from a standpoint of you know w- if lifespans are increasing, is that also going to be a factor in terms of making there be fewer vacancies and more demand and more of a difficulty? I don't know if that's something that you
A
factored in.
1,000%. I mean, you just hit the nail on the head. You know, a 1 year, and I actually just learned this the other day, a 1 year extension in life expectancy is going to grow the demand by 50%. So what you're seeing right now, the probability of people living to 100 that are 18 right now is I think it's over 40 or 50%. So life expectancy is increasing. The quality of care is improving. The ability to extend lives is significantly increasing. And then as far as, we do have residents pass away. It's definitely, senior living is definitely has a greater emotional component that, traditional apartments don't. But as far as like, new residents right now, moving somebody in is very much a family decision. And, when you go out and you get an apartment, you might walk into the leasing office, tour an apartment, shoot a few texts. You might even sign a lease that day. With senior living, there's typically anywhere from 8 to 12 interactions between the sales director and the new resident and the new resident's family before they actually choose to move in. It's a family decision. It's a very impactful decision. And a lot of instances, it's a very emotional decision, because we don't want to be, me as a son, I don't want to be that son that just went and took his, put his mom in a nursing home. Like that just, there's a stigma around it that we're really trying to address and shape. So the one component that, some of the metrics that I talked about, at the beginning of the conversation about, the 1 to 1.5 million unit shortfall, that doesn't take into account, the growing life expectancy that we're already starting to see in seniors.
Mm-hmm. Yeah, that is very interesting. And I guess I wonder if fast forward many years down the line, do you think that the population being smaller of younger people, is that going to be a problem for the sector? Is it going to end up being oversupply?
I mean, we're talking 75 years, 50 to 75 years in the future. You know, I guess that'll be TBD. 75 years. I hope I'm around. Hopefully they, find something really creative to do. But as far as that's concerned, yeah, I don't really know how to answer that one.
That's good. It's a fine answer because I don't think anyone's a genie. So yeah, that is too far down the line to do anything more than speculate.
Yeah.
And even speculate with any degree of certainty is pretty improbable. I only ask because I'm 21, and when I think about my investments, I think about like really long term, and that's kind of why I love multifamily, because I know that people love roofs, and population tends to go up, and land does not grow. So
Yeah.
I'm pretty good as an investor if I'm in multifamily. But
Absolutely.
yeah, it's real estate's awesome. Well, on that note, you ready for the lightning round?
Yes.
Let's do it. So, what superpower would you want if you could have any superpower?
Fly, hands down.
That's the most popular in real estate. Make sure you don't have any roof damage. So, what's your favorite book, or what's the one that's helped you the most?
I would say Jocko Willink's Extreme Ownership, or David Goggins' Can't Hurt Me. David Goggins, that book was just, I mean, you just read it and you're just like, holy shit, like, how does this guy even do what he's doing? Like, I don't know if you've had a chance to read it, but, he went through, SEAL training 3 times, or I guess BUDS, 3 times, his last round, his final round, his last ditch effort, he duct taped his legs, because he had broken feet and broken shins. I mean, the guy is an absolute beast. So yeah, I would definitely say, Jocko Willink's Extreme Ownership, or David Goggins' Can't Hurt Me.
Yeah, David Goggins he's amazing. I listened to podcasts with him. I have not read his book yet, but
I would do the audiobook of David Goggins, because there's a lot of anecdotal talk within the audiobook that you wouldn't get in just reading the book.
Yeah, and that's what I loved about Extreme Ownership, because Jocko Willink is reading it, but he's telling you the stories, and it doesn't sound like it's from the book. It sounds like he's telling you war stories, and he's telling you business stories, and then he's giving you his real lessons. It's so
that
so
was
amazing.
crazy. Yeah,
definitely recommend. So what motivates you to continue every day?
I've got two beautiful girls, ages 6 and 9. Definitely being able to, provide and, give them a lifestyle that I certainly did not have growing up. And then, I mean, quite honestly, just, I love doing deals. I love the relationships. I love being able to, help people. People have, just like quite literally just piles of money that they have to invest, and they want to do it in a smart and strategic manner. So I like being able to, work with people and, not only deliver performance from an asset performance perspective, but also a financial perspective. And now in this role, as head of investor relations, being able to work with accredited investors and actually allow them into, take ownership into some of our deals.
Great. And recommend getting Rich Dad Poor Dad for Teens for them very soon. Gotta get them early with the real estate goodness.
Yeah, absolutely.
Perfect. So what advice would you give to someone who wants to follow in your footsteps?
I would say don't get caught up in the moment. There's going to be just some shit days. But I would say keep making progress every day. Whether it's 5 minutes or whether it's an hour, just keep working on your craft every day. Whether it's starting a business, every day you're not working to improve, you're going backwards.
Awesome. Yeah, it's definitely fundamental to being a lifelong learner. So that's awesome. Since I put you on the spot, I want to give you a chance for revenge. So what's one question you have for me?
I guess from a macroeconomic perspective, how do you see the next 5 years shaking out just in the real estate industry in general?
Yeah, I see. The hardest part is to see how far we've come up, and if that is, fundamentally because of the fundamentals, or if because some, just inflation in the money supply just increased, just money just had to flow somewhere, right? And so everything bubbles up because of that. So I mean, as much as it in terms of what I'm thinking about, it really depends on what the Fed wants to do with the money supply. They grew it by 40%. That had a great impact on real estate. And obviously these prices in real estate wasn't just a function of the money supply increasing as a financial vehicle. The rents increased because the wages increased and because the, demand increased. And so it's not, it doesn't seem like it's bubbled disproportionate to the rents that we're achieving, but definitely still seems to have inflated a lot. That being said,
so what you're actually seeing, sorry to interrupt, just on the demand side on the apartments kind of mirrors what we're going to see in senior living. You had all these Gen X, Gen Y, Gen Z, and the millennials, moving out from their parents' homes, needing their first apartment. So you saw this massive demand demographic enter the market without available housing. And it just happened to come at a time of, post-pandemic, so just to kind of reiterate, we just saw it happen with apartments. The same thing is building on seniors, and it's going to happen.
Yeah. So, from that I guess that's a macro picture, but from that, that application in just senior living, definitely seems like that fundamental is stronger than any of the speculation I'm doing about the asset prices, because it really matters that you have strong yield that's good risk adjusted and it's stable and it's it's tied to an actual good reason in the economy. But to get back to where I think things are going, the Fed is taking money out of taking money out of the money supply as they realize they did too much. I don't really believe that they can do it for that long before they don't want to anymore, honestly. I think that inflation is in the best interest of the people, of the government, and they're going to want to keep doing that. It's a way of taxing without cutting people's incomes. So there's a lot of debt on their books that they have to pay for, and inflation is how they pay less for that. So I don't believe that they're going to continue to bind themselves and make it harder for them to pay back their debt. And I think when they have the power to avoid paying debt, they're going to avoid paying debt. I think that's fundamental to why I believe rates have to come back down and will come back down. Easing the tension in that we currently are experiencing. And that being said, I believe even at these rates, if you get good discounts on prices, I want to do that because I want to buy it. I want to buy there because if my basis is lower, and even though my cash flow might not be great, when rates come back down, that's going to put upward pressure on prices. Then I could refinance, cash out that money. I have a
Yes.
more expensive asset. I have amazing cash flow now, and I got it all at a discount because you can never fix your basis. You can never fix what you paid for a property, but you can fix your interest rate in the future. And
Yep.
so I'm bullish. I'm also 21 and I have a long time horizon, so I'm very bullish. But that's kind of where I see things going in the short term.
Awesome. I completely agree with you, Ben.
Awesome. Well, this was a great conversation. I hope everyone listening learned a lot. I definitely learned a lot about senior living. I hope everyone's as excited as Stuart and I are after hearing the fundamentals of the investment. But yeah, Stuart, thanks for coming on.
Hey, thank you very much, Ben.
Awesome. Well, Stuart and everyone, keep making milestones.
Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.
The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.